Hey everyone, welcome to Token Topics. I hope you're all doing great. XRP, XLM, and a great economic collapse and possible depression are the topics. Many are living in fantasy economics while the reality of things is showing through these current banking issues. There is no better assets to hold than the solutions to these issues. We're going to get filled in on the latest news between XLM and XRP. Also, we're going to hear words from very intelligent people on our economic outlook. Please remember, I'm not a financial advisor. Let's go ahead and begin. Keep your crypto safe with a DCENT Biometric wallet. With talks about exchanges going down and cyber attacks, it's smart to keep it on a hardware wallet. Purchase it now through Token Topics and receive a discount. I'm going to put the affiliate links in the description below. Before I dive into these awesome informative clips from David Lin and Michael Cohen, I'd like to play this clip where Danielle Dixon's going to speak on Bloomberg. She believes that we are going to see stablecoin regulation this year, which would be very good news for the crypto industry, especially for blockchain projects like Stellar, Ripple, Stronghold, and others.
Washington, I'm assuming you're having conversations around this. How optimistic are you on the regulatory front here in the U.S.?
So I feel like we need to get something done here in the U.S. in order for us to really set the standard, if we want to set the standard, which I think the U.S. government is going to want to do that. So I'm very optimistic that we're going to get something on stablecoins by the end of the year. And the reason why is because we don't have a choice. If we want to have a voice in this, we need to get it done this year.
When you say the U.S. government, who are you referring to? Is this a congressional question? Is this the SEC CFTC question? Is it the Biden administration and directives coming from the White House? I mean, who realistically is in charge?
Well, we've actually already seen the Biden administration indicate, at least on stablecoins, that we need to see something happen there. So I feel like that's already been a directive from the White House and the administration. And then we do need to see in Congress, we need to see them take that and run with it and create something for us. So they're in charge of the legislation with respect to stablecoins, in my opinion. And we need to see it because once we see stablecoin legislation, we're going to see adoption of more, by digital assets, of more companies that are in the Web 2 space, which is essentially what I think we want. If we want a strong U.S. dollar, and we want a strong U.S. dollar globally, a U.S. dollar stablecoin is a way to see that happen.
You are, Danelle, at Stellar behind the development and growth of this technology in this industry. Does it have to be in the U.S.? Or why are you so U.S.-centric, seeing as other countries are so much friendlier to the crypto industry than the U.S. seems to be?
Well, I love the fact that other countries have actually taken a lead on this, but I don't want us in the U.S. to be forgotten because I think it's a really important place where we have a lot of innovators and a lot of developers who are already really focused on this tech stack, and we want to see them be able to get their technology out and make it more utility-focused and usable. So I just don't want us to stay so far behind in the U.S. that we lose sight of what the value is, which is actually really getting these technologies to the U.S. consumers as well. And to be honest, if we don't do something in the U.S., we're going to be in this bifurcated world where we have legislation outside the U.S. that's more friendly to crypto. We're going to have companies being outside the U.S., and we're still going to have the issue where U.S. consumers are going to want to leverage this technology. So what are we going to do in that scenario? So I'm optimistic only because I don't think we have a choice.
Thank you for being patient with me. I've had a very hectic and busy week, and I got a lot of side work going on, but I am going to try to push out content as often as I can to keep listeners and viewers informed. I'm not sure if you noticed, but I try to approach putting out the information in a different way than other content creators, because a lot of times, I'm sure you know what I'm talking about, you can go through a list of content creators, your favorite ones, and a lot of times it's the same information over and over again. So I try to avoid that. I try to come up with fresh ideas to give the audience so they have something fresh to go with. But while I was extremely busy, I could still listen in into some awesome content. And David Lin, I discovered his channel, and he's one of my favorite reporters. He's interviewed a lot of people. He's on Kitco News, and I just discovered he has his own YouTube channel. So we're going to go over some clips, and I'll put the link to his channel down below. But he interviews a lot of interesting people that really have a good idea of what's going on. And you can't trust the central banks, you can't trust the government, because they're going to tell us all the way until the moment that they collapse that everything is fine. Anybody who's been studying knows that that is a big fat lie. Most likely they are telling us that because they don't want to create more panic. They don't want to create more bank runs. because people really knew how bad it was. They'd be pulling out their money out of the bank so they can make other financial decisions with it. Surprisingly, there's 2 banks that are partnered with Ripple that I know off the top of my head, Bank of America and Credit Suisse, that are having issues. Recently, we just heard about Bank of America. Now, I know that they stated that they're waiting for their lawsuit to end before they will utilize Ripple's technology. But anybody who's been holding XRP for a long time knows that something has been going on behind the scenes between Ripple and Bank of America for a long time, years. Credit Suisse CEO recently stated that they're going to rise from the ashes like a phoenix, and they've been partnered with Ripple, I think, since 2017, if I'm not mistaken. These are definitely uncharted waters, because not only are we having the inflation, we're having the banking crisis going on right now. You know, ever since COVID happened, everything has been thrown out of whack. Supply chains has become worse. If you're holding these assets, you're actually holding the solution to the problems that we're having. Talk about a great wealth transfer, because we have these collapses like everybody's talking about. The first ones to go up and dramatically in price are going to be the ones that are going to be utilized by the banks to help these crises. I don't think it's a coincidence that all these banking issues are happening at the same time where the BRICS nations are talking about dumping the dollar. At the same time, we're coming towards the end of this Ripple case. It's like the perfect storm. And there is no better time to be holding these assets than now. It's better to be a year or two early than a moment too late. And the price of this explodes. Now I want to share a couple clips. First from Michael Cohen and then David Lynn.
Folks, everyone, the Federal Reserve and the banks are in full panic mode right now, as over $500 billion in deposits has been withdrawn from the banks. They'd like to tell you, don't worry, the banking crisis is solved, it's all over, there's nothing to worry about. But that couldn't be further from the truth. We've also got some Federal Reserve minutes that has been released, and the Federal Reserve is admitting now that we're likely going to be entering into a recession very, very soon. Now, what you have to know about with these central banks is they'll never tell you like it is. So when they tell you the economy is great, you'll know, well, we probably have a bit of a weak economy. When they tell you the economy is weak, you know we're probably in a recession. When they admit we're going to be facing a recession, you better believe we're probably going to be facing a depression. So everyone, what is the Fed so worried about? What is really happening with the banks? Well, let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Well, everyone, look at this. Fed expects banking crisis to cause a recession this year, minutes show. Well, I think this is very obvious, everyone. And what this is going to lead to, for those that don't understand, this is going to lead to a credit crunch. This is going to lead to the banks to be very, very careful who they lend their money to, because their deposits are fleeing and they don't want to have more bad loans on their books when we're about to get their earnings reports to see how bad their books really are. And I think we may have only just seen the tip of the iceberg. Listen to this. The Federal Reserve staff gave FOMC members a presentation about potential repercussions from the failure of Silicon Valley Bank and other turmoil in other financial sector that began in early March. But they said, don't worry. The banking sector is sound and resilient. While the 3 banks collapsed within a week, and the only reasons why more banks didn't collapse because you gave them unlimited amounts of bailouts, no, I don't think the banking system is sound or resilient, and I also don't think it's sound or resilient if they don't have to have any reserves whatsoever. But staff economists said the economy will take a hit. Yes, it will, everybody, a very big one. Given the assessment of the potential economic effects of the recent banking sector developments, the staff's projections at the time of March meeting included a mild recession starting later this year with a recovery over the subsequent 2 years, the meeting said. Well, what this means is, everyone, we are most likely in a recession right now, but they won't actually declare it until 6 to 9 months later. And they're saying this is going to be a slow recovery. The economy may not fully recover for another 2 years. The crisis has caused some speculation that the Fed might hold the line of rates, but officials stress that more is needed to be done to tame inflation. And we did just get the latest inflation report yesterday, everyone, and US core inflation slowed slows only a bit, keeping the Fed on track to hike rates. So excluding food and energy, consumer prices rose 0.4% in March. So that means if you annualize that, inflation is still going at nearly 2.5 times the Federal Reserve mandate of 2%, sorry. And we all know real inflation is actually double the official figure. So it's more like we got 8 to 9% inflation right now. So the Federal Reserve is very, very worried. But do we have some new news, some new data to tell us that yes, there is reason for concern? Well, people, yes, we do. First things first, Bank of America clients withdraw $2.3 billion from US stocks of all sizes. So real estate shares saw the largest outflow since July 2021, and communication and staples were only two areas seeing inflows. So this is the second consecutive week of outflows, Bank of America strategists led by Jill Carney-Hall wrote in a note. The analyst didn't specify the reasons for withdrawals, which was evident across all client groups, and selling was pronounced among institutional, retail, and hedge fund clients. So everybody is getting out of Bank of America, everyone. But it's not just Bank of America, everyone. And again, that is just the tip of the iceberg. Look what's going to be announced when all the big banks release their latest earnings reports and we get to see their balance sheets. Look at how much money has been withdrawn from the banks since the banking crisis. Now, you may want to sit down because you may fall over after this. Look at this. Top US banks to reveal $521 billion deposit drop, most in a decade. So that's right, everybody. This is the biggest withdrawals we've seen since 2008.
And are we going to have a recession? The question is it going to be a depression? You know, I mean, if we just get away with a recession, we're getting off easy. But I don't think there's any way that the payoff, or the payback rather, for over a decade of 0% interest rates and massive quantitative easing, I don't think we're going to get away with just a mere recession as a result of that. It's going to be a depression, and I think it will be worse than what is known as the Great Depression, the one that we experienced during the 1930s.
Stock markets have fallen on Monday morning as recession fears continue to grow. Are these fears warranted? Well, the S&P 500 is down 0.5%, with the NASDAQ down about 0.8%. Peter Schiff joins us to break down market action and his outlook for the economy. Peter Schiff is the Chief Market Strategist of Euro Pacific Asset Management. Welcome to my new show. Peter, honored to host you.
Well, I'm glad to be here, David, and congratulations and good luck with the new format.
Thank you very much. One of the more famously correct calls you've made in your career is prior to 2008, you were warning that 2008 would happen and that the banking crisis would unfold the way it did, more or less. And you were correct then. Let's see what's happening today. I'm just going to quote a report from Morgan Stanley that's been making the rounds on the news. That's rather alarming. Morgan Stanley strategists said that more than 50% of the $2.9 trillion in commercial mortgages will need to be renegotiated in the next 24 months. And they said that peak to trough CRE commercial real estate prices may decline as much as 40%, which is worse than in the great financial crisis. So let's break this down, Peter. Let's assume they're right. The question is, are housing prices in a bubble? Will they collapse? And two, how exposed are the banks?
Well, the banks are very exposed, and anything that was interest rate sensitive is in a bubble, because we had interest rates at zero or practically zero for over 10 years. And so during that period of time, a lot of debt was taken on to buy a lot of assets. And because the interest rates were so low, people buying those assets could overpay. And so it was the low interest rates that helped to inflate the bubbles. That's the same thing that happened in the bubble that popped in 2008. And one of the reasons I was able to see it so clearly before it popped is because I recognized how Fed policy had inflated it. And, you know, even before that bubble popped, I was forecasting the next one, which is the one that we've been living in for that entire decade. The only thing that's surprising to me is not that it's deflating, but that it took so long. But the current banking crisis is just another financial crisis. It's caused by the same factors that caused the last one, which is the Fed and its easy money policies, quantitative easing, 0% interest rates. Except this time the Fed succeeded in inflating a much bigger bubble than the one that popped in 2008. And I think the 2023 financial crisis is going to be a lot worse than the 2008 financial crisis. And it's probably not going to end in 2023. It's probably going to bleed into 2024.
In what way will it be worse? Are you saying that it's not just the banking sector that's going to be affected?
Well, every segment of the economy took on too much debt. Now, obviously, the banks are very vulnerable because the banks own a lot of that debt. But corporate America is in a lot of trouble. Where do you think corporations got the money for all these share buybacks? Most of it was borrowed, and a lot of those loans are going to come due. So it's not just the commercial real estate sector, but corporate America that's in trouble. And Americans also have record debt. We have credit card debt, student loans, auto loans, mortgage debt. None of this debt would be anywhere near as large if it wasn't for how low interest rates were, because that's what made the payments affordable. But as interest rates reset, the payments become unaffordable. And the other problem is the buyers of these mortgages and bonds. I was pointing this out for years before Silicon Valley blew up, but I was warning about the impact this was going to have on banks and every other creditor when interest rates inevitably rose, and they would have to rise much higher than anybody thought because inflation would be a much bigger problem than anybody imagined, but that this would result in significant losses for the lenders.
Since you brought up the recession, Peter, is there going to be a recession is my basic question. Let's start with that, and then I want to bring up some tweets that you made.
Well, I think that's a foregone conclusion. The question isn't, are we going to have a recession? The question is it going to be a depression? You know,
not see a bubble economy for our kids will probably not even see a bubble economy decades and decades from now. It happens once in a lifetime at most.
And this is the bubble of our lifetime right now.
This is the bubble of our lifetime and bigger than either the 1837 peak or the 29 peak. This is going to be the biggest crisis in the baby boomers' life. The biggest crisis of the Bob Hope generation was the Great Depression. This is going to be the big crisis. The final kind of depression into this is going to hit the baby boomers the hardest because they're going to need that net worth that's going to disappear at the speed of light. And I mean disappear, not come back.
Our next guest is calling for possibly the largest crash in our lifetime in the markets. Why is this happening? Where are we in the multi-wave cycle? Harry Dent has the answers. He is the founder of HS Dent and the author of several best-selling books, including 0 Hour, Turn the Greatest Political and Financial Upheaval in Modern History to Your Advantage, and The Demographic Cliff, How to Survive and Prosper During the Great Deflation Ahead. Harry, wonderful titles you've written, wonderful books. Everyone should check out your site, hsdent or harrydent.com rather, and your newsletter. Welcome to my show.
Nice to be back, David.
You're calling for possibly the greatest crash in our lifetime. We already had a pretty big downturn last year. The S&P 500 was down 18% year on year, but that's not it. That's not the crash you're talking about.
Right, and in the 2008-9 crash was 57% on the S&P 500. So yes, no, this is basically what that crash should have been. People didn't notice. It's pretty obvious. About a year and a half into that crash, the central banks just stepped in and just started printing money, unprecedented rates to blow us out of that. That's what basically happened. So that recession didn't really do its job of flushing out the greatest debt bubble in history, which I've been warning about for years and decades, bigger than the Roaring '20s, which ended up in a bubble in the stock markets, and the crash of a lifetime back then, now down 89%. For the Dow, which was the leading index back then. I'm predicting as much as 86% for the S&P 500 in this crash and 92% on the NASDAQ. So in that realm of something you only literally see once in a lifetime, if that. So this is nothing. This is what my point is. Most financial advisors are right most of the time. You can just sit through most corrections and rebalance and that sort of stuff because it's not easy to time the market, as most people know. Okay, but this is so important that I am timing the market. I warned about this in my newsletter, off the charts. 2 huge warnings in mid and late December saying this crash is about to happen. It is going to be the crash of your lifetime. And next thing you know, we were down 38% in the NASDAQ in October of last year. And that's just the first wave down. There's two more to follow. And I think we're just about to see, or we've already started the next wave down, which could take the NASDAQ down to 8,000 just in this next wave, not the end of it. And that's going to be down a little over 50%. And that's when people are going to know this is not a big correction. It is a major crash, one that you have not seen in 73, 74 or 80, 82 in your lifetime, and one that even the millennials will not see a bigger crash than this when their boom and bust hits many decades from now.
I remember the first time I talked to you was late 2020, and you had predicted that we would begin this crash. I think it was first or second wave, and eventually it did come. You were correct in that 2022, last year, saw the stock markets and cryptocurrencies all crash, not to the extent of 50%, but actually 2022 was the most severe crash for stocks and bonds collectively if you put them together as a percentage of GDP. So in that regard, you were correct. However, it did happen later than you initially anticipated. Why did it happen later, you think?
That's extremely simple. Never before. Look at the Great Depression. Look at any major downturn. The mid-70s. Never before have central banks declared war, literal war on recessions, and said, we will not let the economy fall. Mario Draghi was the first one to say, he said to traders who were shorting the European markets back there in 2020, when we should have had the real crash started, okay? He said, I will print unlimited amounts of money. Do not bet against me, you damn traders. And that's what they've done. They have pushed this off. But even with all this unprecedented $9 trillion for the Fed alone in money printing, never have we seen even a fraction of that, okay? Even with all of that, we keep falling back in a recession. We just came out of the COVID downturn, and with all this massive stimulus, $10 trillion, half of it fiscal, half of it monetary, the biggest single 2-year stimulus in all of history, topping everything before that, and we're already falling in a recession again. That's the problem. The economy underneath is really, really weak and really needs to get rid of a lot of really bad debt and zombie companies. And the central banks won't let the economy do its thing. Oh, we're free market capitalists. No, we're not. If you trusted the free markets, you'd let the free markets do what they do. And central banks have declared war on the free markets. That's the problem. And the free markets, thank God, look like they're going to win this. I've been fretting to my subscribers saying, I don't know if we'll ever have free markets again. I mean, this may never end. If the economy gets its way and we have this crash, it means the markets have taken back over. They're going to do what the economy really needs and not listen to stupid central bankers who never had sex or run a business. Find me one that meets either of those two definitions or looks like it. What are these people doing in charge in the first place?
Well, everyone, that's all I have for the video. Please put your thoughts, your comments, and opinions down below. As always, thanks for watching another edition of Token Topics.